Hello. My name is Nicolas Véron. I'm very honored and pleased to introduce this session to discuss Patrick Honohan's new book for the Peterson Institute, The Central Bank as Crisis Manager. There used to be a time when publishing new books was kind of a bread and butter activity for the Peterson Institute, but now it has become very special. So this is a special moment for Patrick's book, and it is really a treat. Patrick, of course, joined the Peterson Institute for International Economics in March 2016. He had a distinguished career both in academia and policy, as all of you already know. He was as the governor of the Central Bank of Ireland and a member of the Governing Council of the European Central Bank from September 2009 to November 2015. And he also has earlier experience at Trinity College Dublin, at the World Bank, where he spent 12 years, at the Office of the Prime Minister of Ireland. So basically, there's nobody who is better qualified to write that book, and we look forward to his presentation. We also will have discussions by Steve Cecchetti and Ceyla Pazarbasioglu. Steve Cecchetti is a Rosen Family Chair in International Finance at the Brandeis International Business School. He's a research associate at the National Bureau of Economic Research. I'm not going to list all his academic credentials, but I will say that he used to be the chief economist of the Bank for International Settlements, and of Ceyla, who is, of course, the director of the Strategy, Policy and Review Department, SPR, for the Washington Beltway dwellers. At the International Monetary Fund, she also has very extensive experience, including on the ground in Turkey in banking supervision, but also, of course, throughout her career at the IMF and the World Bank in dealing with many crises with many central banks. I have one example in mind, which is Spain in 2012, but it's only because I happen to know that one. And with that, Patrick, over to you.
Thanks very much, Nicolas. So, listen, watching the reaction of central banks whenever a financial crisis breaks out, I'm often struck by the impression given that this sudden stop has come as a great surprise, as something for which on-the-spot improvisation is the best response that could have been expected. But my purpose in writing this book is to tease out from this observed experience what it is that central banks need to be prepared for and how their behavior in a crisis does and should differ dramatically from normal times. Of course, central banks have been working hard to prevent financial crises, but sooner or later, for many countries, the sudden stop will descend on financial markets. Busy with their business as usual task of restoring or maintaining price stability, many central banks have failed to detect crisis wake-up calls that seem obvious in retrospect. It's probably not to be wondered at when boosters wave aside the risks of a crash with the insouciant remark, "This time is different." Well, they're not wrong. Each financial crisis comes up in its own distinctive way and is not fully recognized before it actually breaks. But when the sudden stop is at hand, it is essential for central banks to be able to take in the situation, the whole situation at a glance, and to have a plan of action quickly to contain the fallout, a plan that takes account of the ever-changing complexities and of the interacting business models being used by financial institutions. Last year's big banking failures saw financial authorities in the United States and in Switzerland flip-flop as they scrambled to master the emerging situation and prevent a contagious spillover to the rest of the financial system and the economy. So relative to crisis prevention and failure resolution, and of course to the core task of price stability, central banks may not have devoted enough effort to being prepared for crisis management and containment. Actually, a financial crisis turns on its head the kind of behavior that characterizes business as usual at the central bank. Normally, it can function on well-defined, straightforward core objectives: price stability, prudential supervision. Its deliberations will be gradual, measured. Public messaging will be repetitive and conventional, and it will tend to hold the government, the Treasury, at a skeptical arm's length, seeing it as a prime source of inflationary pressures. But in a crisis, central banks need to work quickly to take account of the shifting complexities of modern finance in order to identify the optimal corrective measures that will contain the crisis with minimal financial or economic damage. They will have to prepare subtly nuanced communications, and they will need to work closely and cooperatively with the Treasury and other government agencies. Here's my schematic, these 4 dimensions. But in this book, I review a dozen recent financial crises from 4 continents, showing how these characteristics, speed, complexity, nuanced communication, and close cooperation with the government, have tended to feature. I distinguished between banking crises, wider financial sector crises, and then the all-engulfing macro-financial crises. Each of the banking events I look at reveals clearly the speed of the unfurling events in comparison with the more gradual evolution of inflationary dynamics. The depositor run on SVB famously outdid any previous banking events in terms of speed. It also revealed the key role of Treasury central bank interaction in moving to a solution, given the blanket guarantee and the Treasury indemnity provided to the Fed. The flip-flopping that occurred over the weekend following the intervention also hints at insufficient preparation. But the Credit Suisse case is even more informative, especially on the dimensions of communication and complexity. Whatever you may think about the solution eventually adopted in Switzerland and how it will resonate in terms of the future of the Swiss banking system and in terms of the global approach to the use of resolution powers, it is clear that the Swiss financial authorities faced a difficult situation when the general slide of market confidence in Credit Suisse fell over a cliff midweek. What happened in the next few days remains controversial today. Once again, speed was of the essence. The scale of the midweek outflows from Credit Suisse meant that the Swiss National Bank would have to provide emergency liquidity if Credit Suisse was to stay open until the weekend. The SNB wanted to provide that liquidity, but they encountered what may have been an unexpected obstacle. You see, although Credit Suisse's liquidity coverage ratio complied with regulations, some of the high-quality liquid assets credited to this ratio were tied up in collateral margin in clearinghouses used by the bank and couldn't therefore be accepted as collateral for a loan from the SNB. So Credit Suisse did not have sufficient eligible collateral free and available to access the sums needed to meet outflows. The government would need to enact an emergency ordinance, giving the SNB a higher bankruptcy preference so that it could legally provide the emergency loan. So the need for Treasury, central bank, or government central bank cooperation is well illustrated here again. Curiously, that law, which was enacted midweek, was not immediately made public, presumably to prevent further depositor worries. So all of this does suggest that the relevant authorities could have been better prepared. As the depositor run continued that week, official communications needed to be stabilizing but not misleading. Were they? Even though emergency liquidity was being prepared, perhaps it was okay for the SNB and the regulator FINMA to emphasize in a joint public statement that Credit Suisse met the capital and liquidity requirements for a systemically important bank. But they added that this compliance, and I quote, allows negative effects of major crises and shocks to be absorbed, which now looks at best rose-tinted. And then there's the well-known story of Credit Suisse's alternative Tier 1 securities and their unusual contractual features. And it illustrates the kinds of complexities that can be embedded in what, in some ways, appears a fairly plain vanilla bank failure. My reading of those contracts makes it clear that what was done was explicitly foreseen in those documents. But it certainly left many observers and officials in other jurisdictions scratching their heads in wonder at a set of transactions that wiped out these bailable bondholders at the same moment as shareholders crystallized a payment of $3 billion. I also include some words about the banking failure events immediately after Lehman Brothers collapse. But with the substantial tightening of bank regulations and supervision after the global financial crisis, attention shifts to wider financial market failures, extending to non-bank financial intermediaries and to the functioning of wholesale financial markets. The dash for cash at the outset of the COVID pandemic in March 2020 is an important instance, which I do cover in the book. And I also have things to say about the Chinese equity and foreign exchange market turbulence of 2015. It's in an institutional environment where the National Central Bank is not as dominant or independent an entity. And about the euro area crisis with its fear of a breakup of the currency area until Mario Draghi's unparalleled communications coup of July 2012. But among those wider financial sector events, let me today single out the UK pension fund, LDI, liability-driven investment crisis of September 2022. It's a remarkable downward spiral in the price of British government bonds, gilts as they're called, immediately after the government's poorly received budget statement that month is particularly interesting. This event landed the central bank, the Bank of England, in a tricky situation. You see, they had a threefold objective, but only one instrument. That instrument was the purchase of gilts. Its objectives included the following three. One, reduce the bank's holdings of gilts as part of the effort to tighten monetary conditions in order to bring inflation under control. Two, make sure that the bank will not be seen as providing political support to a weak government that had just announced a lax budget. Three, halt the downward spiral in gilt prices, which is being amplified by massive correlated sales of gilts by pension funds. Pension funds had to meet cash calls on their complex leveraged investments. These were triggered by the initial fall in prices. Well, the first two problems suggested a need to continue to sell gilts in line with the recently announced program. But the third called for purchases, what to do and how to communicate. Dealing with this unusual situation required that decision makers at the Bank of England understand a recondite set of LDI contracts and the mechanics of the business model of a segment of the financial sector, the pension funds, that it was not expected to supervise. In this case, cooperation with the government would evidently not have been a good idea. So despite receiving calls from sources sympathetic to the government seeking a reversal of the policy rate increase of the previous week, Governor Andrew Bailey decided on a statement reaffirming the Bank of England's commitment to the first two objectives, price stability and no bailout for the government. But that announcement didn't help the bank achieve its third objective, halting the self-amplifying price decline. And many financial market participants regarded it as an inadequate response to the market dysfunction. It seemed that the Bank of England's initial response was too slow. Only after a couple of days did the bank address the third objective, announcing that after all, it would buy gilts over the following 2.5 weeks in order to restore orderly market conditions, 13 working days. The firm time limit raised eyebrows. Announcing a limit was clearly intended to confirm that the Bank of England was not going to bail out the government by making open-ended purchases. But would it be long enough for market functioning to stabilize? This was high-wire acrobatics. But in the end, it worked. Speed, complexity, nuanced communication, all well illustrated here. Still, it partly relied on inspired improvisation. My third category of crisis is the all-enveloping macro-financial crisis. There is a long list of such events in developing and emerging economies in the last half of the 20th century, of which one of the most dramatic was the 1997-8 collapse of the Indonesian economy. It's an old story. It's my only pre-Lehman case, but it's a good one to study. Indonesia had been the darling of foreign investors in previous years, but its governance weaknesses had been undermining banking and political institutions. In managing the crisis, the position of the central bank, is called Bank Indonesia, was very difficult, especially when it came to relations with the government. After all, socially optimal containment and resolution policies would damage the private interests of family members and friends, the autocratic long-term president of the country, Suharto. Thai baht collapse in July 1997 did not immediately cripple Indonesia, but it unleashed a critically dangerous market dynamic for Indonesia. The sudden stop came in the first week of October 97, at which point the IMF was called in to deal with the consequences of exchange rate collapse and outflows. Actually, this famous photograph is from a few months later, but I couldn't resist putting it up again because it's such a good piece of journalism, that photograph. Management of the crisis over the following months was confused and catastrophic. The collapse engulfed the entire economy. Real annual per capita GDP shrank by more than 1/7 in 1998. Recognizing as soon as they arrived that a large number of banks were technically insolvent, IMF staff persuaded the authorities to close 16 small banks immediately, and it was communicated that only small holders of deposits would be compensated. This was seen by many observers as a half-baked measure, especially when one of the closed banks, owned by one of Suharto's sons, was quickly reopened under a different name. Depositor concern at other banks only deepened. Ever-growing emergency liquidity from the central bank financed deposit outflows in an accelerating monetary death spiral, with the rupiah falling to less than 1/6 of its pre-crisis value. Well, this was certainly a complex situation to navigate. Had Bank Indonesia more effectively learnt the lessons from, for example, the boom and bust experience of several Latin American countries in the 1980s, it might have better realized the extent of the economy's exposure to corporate and financial sector fragility, the destabilizing potential of open-ended liquidity support to the banks, and the need for far-reaching and persistent reforms to restore stability. And on the top of that, the central bank had, as I mentioned, to deal with an autocrat. Suharto fired Governor Jiwandono when he tried, rightly, to discourage experimentation with a currency board solution. One wonders whether a more persuasive line of argument might have succeeded in convincing Suharto away from an approach to crisis management that, in the end, not only crashed the economy, but ended so badly for Suharto himself. But my other examples of macro-financial crises in the book are all more recent, including Argentina. It's a perennial source of crisis narratives. This one from 2018. Iceland, 2008. Lebanon, 2019. And the Russia-Ukraine wars of 2014 and since 2022. I also have several observations about the Irish crisis, which pops up in different chapters. Each event differs in important ways from the others. The true historian of financial crises must resemble Isaiah Berlin's fox rather than his hedgehog. How can the central bank be better prepared for what it needs to do when the sudden stop is at hand? I devote a chapter to reviewing some approaches to improved preparedness. One aspect is the policy toolbox, notably on emergency liquidity and on deposit insurance. I won't have time to go into my propositions on those. These are the classic crisis management tools, but the cases show that how established procedures in both of these areas are not politically viable in practice. And then there's staffing at the central bank. I mean, for example, the required skills for relevant market intelligence, which is a key requirement, and the design of containment interventions. This relevant skills include those of financial economists, company analysts, financial engineers, investigative financial journalists. Those guys can have the capacity to piece together snippets of information and strands of market gossip. Attracting and motivating people with these skill sets is not easy. They need to see that their input and knowledge are valued even in calm weather. Their job descriptions need to ensure that they avoid the fate of the lonely Maytag man. There he is in the TV advertisements of long ago. Apparently those washing machines. This is for the American audience. Washing machines are so reliable that the poor repairman really had nothing to do. I'd also like to mention, before I finish, that if the central bank is to do a good job of spotting the threat of an upcoming crisis, attention needs to be paid to contrarian views, even from Cassandra's constantly foreseeing doom. Contrarians are usually mistaken, but the corrective insight that they convey, even when only partially right, is invaluable. A central bank that lacks a thoughtful Cassandra or systematically ignores her is one that will not be ready when a crisis breaks. Well, there's more in the book about preparation, including governance structures that need to be in place and execution. And also the proposition that central banks can only operate effectively if they are trusted. And a series of mishaps over the last decade and a half, not all of them crisis related, have undermined trust. Only if they are well prepared can central banks confidently identify the actions required to most effectively contain an incipient crisis and minimize the potentially large social and economic costs that crisis can engender. Fortune favors the prepared crisis manager. Thank you very much for coming.
Thank you very much for the invitation to come back to the Peterson Institute. It's always a pleasure for me to be here in this room. And thanks to Nicolas for the very nice introduction. My job is to discuss this, which meant that I read the book, something that I don't usually do for books that are my work. But I also read another book recently, which was, Nicolas wrote this excellent book, if you haven't seen it, on the banking union in Europe, which I commend to all of you as well as this book. And I think that Patrick just summarized why it is that you should read this book. So the first thing is that there are these extremely useful summaries of crises. I thought these were just great. Obviously, they're Patrick's view, and we can have, as you read these things, those of you that have lived through a lot of them will have minor complaints. But I still think that if you want to give somebody something to read where they can understand these crises, these summaries are really excellent. You said there were a dozen of them. I think there are more. Depends on how you count. There's also this important practical advice, which I've summarized somewhat differently, about maintaining crisis management teams, ensuring legal operational contingency arrangements are in place, and have a clear governance and decision-making structure. Those were the three sort of biggest ones, I think, that are there. And I think that the main advice, of course, is to be prepared. And I think it's quite clear that a lot of people were not prepared and still are not prepared. And so you do have to think hard about exactly what you want to prepare for. And I think that we need to be thinking about how that preparation is done, because a lot of it is done with contingency planning for things that aren't actually going to happen, but that get you ready for decision-making processes, that create relationships that you then need to use. So my job here is to talk about not so much what is in this book, which I really find extremely useful, but what maybe should be in the next book. And so let me talk about that. So first of all, I just want to start with something that's very, very basic, which is, look, we're trying to safeguard institutions and markets to ensure that payment systems operate smoothly and creditworthy borrowers have access to funds. That's my like one sentence summary of what we mean by financial stability policy. There are unavoidable hazards, and these are things that I think you always want to keep in mind. You want to keep these in mind when you're setting up the crisis management system for sure, but also when you're setting up what I'll talk about in a few minutes, which is a prevention system. And that is, you're always going to bail them out. I don't really care who you are. I don't care how tough you think you are. You're not going to let there be a small probability that the system collapses. You're always going to bail them out. Set up the system with the knowledge that you're going to bail them out, because no one is going to believe you that you're not, and everyone is going to play chicken with you, and you are going to lose. And so I think that's the first thing. The second thing is that regulation is an arms race, and that arms race is an arms race that the public sector, the authorities, often lose. They shouldn't lose, but they kind of do. So they're always behind. And what you want to think of in that arms race is, what are the weapons that you need? And those are processes, those are people. I would actually add, Patrick had a nice list of people that we need: financial engineers, financial economists, journalists. That's great. I think what's missing is computer scientists, because in the modern world, I want computer scientists too. I want people who design, build systems that can evade the regulations. And those are often, in the current world, going to be people that do natural language processing and machine learning like things. At least those are the ones I've talked to. The other thing is that you do need to do supervision, but supervision is not going to be sufficient. It's good to do it. We want speed limit. We want not just speed limits, which are the regulations, but we also want enforcement of speed limits. But that doesn't keep people from not speeding. They're still going to speed, and they're still going to have high-speed accidents regardless of what you do. So just be aware of that. Now, this is I think the main point that I want to make comes from this, which is that we want to think of the central bank. So there have been, and some people in this room, including me, have written sentences that say central banks are risk managers. They're not just crisis managers. They're risk managers. Their job is to try to lop off the lower tail of the distribution. And I think that we need to think about the trade-off between crisis prevention and crisis management. And that's I think something that's at the top of the list, and really in the consciousness of a lot of the people that do this. And then that is better crisis management going to make crises more likely? So how is it that we're going to do the crisis prevention that we need to do in order to make the crisis management not unnecessary, but less likely and presumably less costly? So I have a list of things that I would call crisis management tools. They overlap with the crisis prevention tools. They overlap with the crisis management tools because, of course, if you're going to do crisis management, you better do monitoring as well. And Patrick emphasized that in his list of things, and it's discussed in the book. And I think I agree completely with that. You need to build and maintain a comprehensive map, what I would call a map of exposures in the system. This goes well beyond banking. It includes the entire system. It includes, and the question is how you can do that and whether you can do that. And then you can use that to understand vulnerabilities in the system. The idea here is, first of all, to know where the vulnerabilities are, and then also to have some sense of how big the shocks might be. And when the shocks potentially get bigger, as they may have done recently, we need the system to be more resilient than it needed to be before. And so how do we build that resilience? Well, we have a whole bunch of things that we want to do. You know, I want to require self-insurance that's based on realistic accounting principles. People that whine about high capital requirements, I have little patience for. I don't think that they have any social costs, basically. They may have private costs, that's fine, I don't care, because their externalities, those negative externalities, mean that the social costs are extremely low. There's a lot of evidence that higher capital requirements result in far better behavior by banks as well, in terms, and in fact, more lending. Employ the same principle of same activity, same regulation. This is somewhat hard to do. It's somewhat contentious. I'm happy to discuss it later. But I think that that's got to be an objective. It's hard because we regulate by legal form of organization. And so who is it that you're going to regulate? If you're regulating an activity, you can't regulate activities per se. Reinforce market infrastructures, and finally establish standing facilities for liquidity provision and market support. I think that's something that we do need to do, and a lot of people here again have written about it. Patrick discusses a number of crisis management tools. I'll just list a few of them. There's lending and there's purchases. There also are administrative measures that are, and my question about these is whether or not these are really central bank tools. I think that one of the things that's very important, of course, in a crisis is to make sure that the finance ministry is on the same page as the central bank. These may be tools that belong to somebody else. The question is whether or not you can actually employ them if they require legislative action, whether you can do that quickly enough. There was one example in your crises, the example of what happened in Switzerland. I'm not sure Switzerland's a good model for anybody because of the way that the Swiss are able to do things. Having lived there for a while, I can tell you that things work really, really well. The fact that they would get something done in a couple of hours doesn't surprise me, but I don't think that that's really true for anywhere else. So the question is about capital controls and withdrawal restrictions, and whether that's something that really is a central bank tool, or whether or not this is just about having to be in cooperation with the rest of your system, all the other administrative aspects of the government that have tools. So just to summarize my comments, there are lessons from the recent crisis that's very valuable. There's a practical guide for management. You can read through this and you can say, okay, now I can go off and figure out what I need to do. But I think you do need to balance crisis management with crisis prevention when you're doing this. So the one thing that I would say is that we need now to understand how to do crisis prevention in such a way as to get us in the right point of the trade-off between prevention and management. And as I suggest here, ensure resilience, knowing how you're going to behave, and establish automatic mechanisms that are in place. And so in that sense, maybe there's more of an overlap with what Patrick's talking about, but I think that overall it's extremely valuable. It's a great book. Thank you for writing it, and thank you for asking me to read it.
Good afternoon. I'm Ceyla Pazarbasioglu, and grateful to be here. It's such a privilege to be in this panel with Patrick, who I have huge admiration for, and worked even on the Ireland crisis together for a while, as well as many others who are in this room. So I don't have slides, but I do have, let me just put up my notes, but I do have some experience with dealing with banking crisis. I joined the IMF in 1992, and at that time, I was in the European department dealing with Germany and Norway. And I don't know if you remember, but at that time, there was a Nordic banking crisis. And the interesting thing was the Norwegians, the Finns, and the Swedes dealt with the banking crisis in a very different way. So it was almost like a learning experience, because you could see how bad bank, good bank, or guarantees, or other types of instruments nationalizing the banking system in the case of Norway could be used. So let me just pull this up. It's having a hard time. Sorry. Okay, great. So I joined in '92, knowing very little about how to deal with banking crisis, and I must say I learned a lot from these two tables. With Jerry Caprio, with Millard Long, of course Tom. There was an incredible presence in terms of financial sector expertise at the World Bank. Very little at the IMF at the time. It then built up, but it was really incredible to work with these very experienced colleagues and learn from them. So I'm grateful to that. What I would like to make two observations and then talk about some of the lessons in the book, and conclude with some thoughts. Steve mentioned quite a bit, and which was excellent presentation. And I should say the book is great, and I think it has a forever shelf time, because it's just really good to learn about these experiences and understand how different issues were dealt with, because part of it will come in other circumstances. So what I want to talk about is, if you look at the 90s, 2000s, and there were many, many crises at that time, the Asian crisis, the emerging market crisis, you name it. And then, of course, we had the global financial crisis more recently, and then the recent failures that were just talked about. And each time, what we observe is the financial sector has become much larger, much more complex, and much more concentrated. And I think that's the lesson. They know, and the incentive is to become too big to fail, to resolve. So a lot of the tools we have, which are good to deal with idiosyncratic bankruptcies or smaller institutions, are very difficult in the context of these larger institutions. And there was a huge agenda after the global financial crisis with the FSB, and a lot has been done. Resolution managers, I was working on a lot of these topics, and you name it, liquidity ratio, counter-cyclical buffer, all sorts of new regulations. And guess what? And that's my second observation. The risks are now going to the non-bank financial system. So, and there we have very limited tools. So I think it just means that we have to constantly adapt and try to be prepared. But I think prevention is very difficult when you have this moving of risks and limited tools to be able to deal with these changes. In terms of policy response, the more complex institutions get, the more important it becomes to contain the problems, restore confidence, and that's why I think deep restructuring early on becomes very different. During the Asian crisis, we were all talking about asset management companies, diagnostics, dealing with non-performing loans, and so on and so forth. Very little of that during the GFC, and also recently. So that's a big difference. I have not heard much discussion about AMCs. There was a little bit at the time of the US banking problems during the great financial crisis, but mostly it was guarantees, accounting forbearance, regulatory forbearance, guarantees. These are the tools that have been used more recently. So those are two observations. In terms of lessons, I agree intensive supervision is very important. I also agree that it's not going to prevent, unfortunately, systemic crisis. But I think that doesn't mean we should give up, because, as Steve said very well, that's also what you need to manage the crisis. So hopefully it can be less costly crises. But the reason why it's difficult to have intrusive supervision, and the IMF has written many papers on this. There was Learning to Say No, and more recently, it's actually a very good paper, 2024, Good Supervision Lessons from the Field. And it basically talks about it's evidence from our FSAP assessments, and which shows that there is progress in risk monitoring with stress testing, business model analysis, and so on and so forth. But if you look at the recent failures, there were red lights flashing, right? With uninsured deposit ratios very high, with huge growth in bank balance sheets, and so on. And that was one issue that was discussed a lot after the GFC. Actually, Julie Dixon from the Canadian Superintendency had a group, which was an excellent group of supervisors, trying to look at bank business models and understanding how banks make profits and what risks they take to make those profits. But then very little came out after that. So I think there's an agenda that there's an unfinished agenda there. And of course, there are many issues about inadequate legal powers, resources, independence, and so on and so forth that financial sector lobbies, of course, that really create issues for supervision. Nicolas mentioned Spain. I got a lot of white hairs doing the Spanish FSAP in 2011 as they were almost going into crisis. And this was a supervisor which everyone held as a role model. They had real-time data, lots of on-site supervisors. But on the other hand, it was faster to deal with the crisis and once the decision was made, we're going to deal with this crisis, then it was much faster to react. If, of course, required the change in government, but that's a separate story. Second, even smaller banks can be systemic. We always think of big banks being systemic, but several small banks failing at the same time could be systemic. Third, resolution regimes, and this is very well explained in the book, that you need sufficient flexibility because you need to make sure that government support is used in a good way in dealing with a systemic financial crisis, but at the same time, which requires the flexibility, right? You may have all the tools, but it may be necessary to make sure make sure that there is no systemic crisis, that one uses the flexibility one has. Liquidity in resolution, you talk about pre-positioning of collateral. This is something Bank of England was using. I think it's extremely important. Testing preparedness, crisis simulations. Crisis simulations across different supervisory authorities are also very useful. And I can't agree more with computer experts or cyber risk experts because there are huge risks from these type of new developments, and I don't think we are ready. We have now learned how to talk to governments, how to have these tripartite arrangements with different actors that will be solving a crisis, but if there's a major cyber attack, I don't think supervisors talk to national security experts or cyber experts. So I think there's a need to broaden the crisis preparedness, crisis simulation exercises. And also, because it's so cross-border, it helps, and this has been done in the past. Deposit insurance regimes. We have FDIC here. I'm sure we'll hear from them. Deposit insurance, let's be clear, it's not for systemic crises. It's more for idiosyncratic, smaller banks, and sometimes even large banks. But it's for isolated cases. When it becomes systemic, I think deposit insurance becomes very difficult. If the situation is so bad that you end up with having to deal with blanket guarantee, basically, and try to minimize the cost. So I think it's important to think about what is the coverage of the deposit insurance system, what is it trying to achieve, because at the end of the day, the cost will be for the future. The banks that remain safe in the system, which can actually be weakened because they're trying to pay for the deposit insurance if it's a major cost. Lastly, dealing with non-performing assets. I think this is an area where there was a lot of work done in the past, much less so now. So I think this is another area for the second book to think about what are ways to deal with non-performing assets and asset quality reviews, asset management companies, other ways of institutions that can deal with it. I have 40 seconds, and I'm going to use it to say something about the fund. I was heartbroken to see in your book that you call it IMF program. I think it should be IMF supported program. IMF should support countries and it's important. If countries don't own their programs, it doesn't work. So it's very important that countries they understand much better their circumstances. The fund provides knowledge because, we have 190 members, we have learned. But it's also important, and I saw this in Ireland, you had very clear direction as to what you wanted to achieve. I saw this many other countries I worked on. In my own country, we wrote our own letter of intent because it's very important to own that program. It's very simple to just put everything on the fund. I didn't work on Indonesia, but I did work on Korea and Thailand, which was difficult. Warren is there. There were many countries that had difficulties at that time. But there were huge governance issues, huge. And that wasn't the fund's fault. We pick up the tab very often. But I think it's important that the fund uses its FSAPs, uses its Article 4s, the surveillance, to help prepare, but also help manage crises. Thank you very much.
It seems the challenge is not to understand your risks or to discover new ways to think about them. It's just the lessons of experience. And from that perspective, your book, as Ceyla said, I think your book, Patrick, has a forever shelf time. So that's, what can be better than that? I will, we want to take questions from the floor. We won't have time for you, Patrick, to address all the points that have been made by Stephen and Ceyla. I cannot resist asking you a question about one of the points made by Steve, which is this idea of a trade-off between crisis prevention and crisis management, which he made very forcefully, and I think goes to the core of your book. Is there such a trade-off?
I'd mark that down as an interesting point to pick up on. I think this linked, I suspect that Steve's point here is linked to the idea that they'll be bailed out, always. And I'm not sure that's quite true. We've seen too many of those cases where everyone was bailed out, but we've also seen many cases where only some people were bailed out. A number of cases in Argentina. Iceland is a very interesting case. The allocation of losses. Lots of people lost money in Iceland. Lots of people made money in Iceland case. So I think it's a little bit more complicated. I can't imagine a situation where you would say, okay, we have a crisis here, but this one we're really going to mess up, so that nobody takes precautions anymore. I'm old-fashioned enough to think that the fight to limit the fiscal costs of bailing out post-crisis is still worth fighting, not just to say, okay, just pay more.
Okay, I want to open it up. There's a microphone over there. You can stand up and ask questions. I have questions of my own. I have a long inventory, but your questions will be better. Here's one.
Warren Coates. I want to amplify what Patrick just said about bailing out, because I did take exception to what Stephen said about that. The FDIC in the United States closed thousands of banks because they developed tools that diminished the pain of closing a bank and thereby made it feasible. And I don't think we want to give up emphasis in having such techniques that allow us to actually avoid the moral hazard of bailouts. As Cecilia said,
I assume you have a question, and I will also ask you to introduce yourself. Sorry.
He did. Said.
Warren Coates, and I have no question. Thank you.
Can I respond to Warren's non-question? I think an interesting point here is that one of the mechanisms for bailout is, in a way, liquidity provision. That's one of the mechanisms through which, what liquidity often ends up as never getting paid back, in a peculiar way. One thing that happens now that we're all concerned about non-bank financial crises is the question of whether central banks should be opening their liquidity windows to non-banks, and it's a very hot topic. We saw it in the global financial crisis, a limited amount of widening, and the Bank of England last week proposed a new policy saying they are going to have liquidity support for non-bank entities, which is, I think, a very interesting question. I'm in favor of that, but it means that the whole question of bailouts will be widened well beyond the banking system as an issue.
I just want to take issue with the FDIC points. Since 2008, no one has lost any money that had a deposit. Purchase and assumption is a bailout, and that's purchase and assumption at a negative price. So I still think that if you can afford it, you bail them out. That may be the point about emerging markets.
That's a long debate, and we'll have many, many more discussions about it. Morris.
Morris Goldstein, formerly PIIE, and before that the IMF. I also want to congratulate Patrick on a very good book. I've read it. It's very nice. My question is about guarantees, one of the most widely used instruments in a crisis. What have we learned about that? Does anyone venture, is it better to do it, sort of step by step, just widen the guarantees a little and see if that works, or put a time limit on it, or what are the lessons about guarantees?
And obviously Ireland had no shortage of that.
One of the questions, I have to say that the first time I met Morris was 53 years ago. He was part of a research group for young economists at the IMF, and I was a young economist at the IMF there. So, and he still comes up with interesting and complicated questions. Guarantees, the first thing about guarantees is their credibility, because most governments can get caught in a situation where they may guarantee, but they actually don't have the market credibility to follow that. So that was the case, the Irish case. At first it looked okay, they're a AAA country, but pretty soon with the losses being so severe, and it turned out, no, they went down, and Moody's even put them at below investment rating. I think that guarantees can be simultaneously, other European governments, including the German government, gave a sort of guarantee, but they didn't lock themselves in. They used their political credibility to persuade people that probably they weren't going to, without locking themselves into something that was going to be enforceable. I think guarantees are very tricky because, and it's wider than financial stability guarantees, they're guarantees for small businesses and that. They look cheap to the politicians, very attractive to the politicians, don't have to be put into the budget, and end up costing a lot. Other thing about guarantees is be careful about who you guarantee. Some guarantees have guaranteed people who couldn't run anyway. You've got a bond that's maturing in 10 years. Oh, we'll guarantee that for this crisis. Well, no need, because they can't get it out for 10 years.
Ceyla?
I think Patrick covered it very well. It depends on the credibility of the guarantee, and also making sure that there's a sunset clause in the context of some cases. I did want to say something about bailout, though. So, and that's, I have a big problem with bailing out shareholders, because I think they have a lot to do with the failure of the institution. And that is, in my view, a big moral hazard. And avoiding that is important. And second, when you actually in some of the cases, when you look at the large depositors, they also have very large loans. So it's also important to be careful in netting out the deposits and loans and not just guaranteeing or bailing out all deposits. So there's more nuance, I think, dealing with large depositors. And usually they are, several of my experiences, they're actually quite linked to the shareholders.
Point about shareholders you mentioned, and that connects, of course, with Credit Suisse. Would you go as far as saying that the Credit Suisse crisis management was a failure because shareholders ended up getting a little bit of money?
I'm not going to talk about this
being straight.
Exactly. I'm not. I was thinking of earlier crises where, and also in the case of RBS2, the shareholders were protected. I do think it's something that is very important. There may be cases where it's justified because of the details, but usually I think that's an area where we need very clear rules on.
Just say very quickly, I think we need to understand much better why it is that the Swiss did not implement the resolution plan that was in place for Credit Suisse, which would have knocked out the shareholders.
It's an ongoing debate, and I think a parliamentary report is expected later this year, as well as a number of court rulings. I will refrain from giving my own opinion. Please.
Hi, good afternoon. My name is Cecília Fernandes. I am also from the IMF, from MCM, which is the Monetary and Capital Markets. Congratulations for the book. I found it very interesting. Towards the end, I think in the last chapter, you mentioned a topic that I find very relevant, also very much related to what I work with in the IMF, which is the balance sheet losses from central banks. My question to you is, you phrased it rightly so, that it's a very problematic issue when there are big losses in terms of credibility, is a threat for the trust and credibility, but also potential moral hazard issues and related with fiscal. But to which extent do you also think that it can be problematic in terms of operations, really impair monetary policy implementation to the point that the objective might not be even met for certain central banks? Do you see that we could go as far to say that, or you think that is much more contained to the credibility sphere? Thank you.
Central bank balance sheet accounting, there's nothing that sets our pulse racing more at Peterson than that.
Absolutely, and there are many recent papers on this topic. My impression is that this is largely a question of trust and confidence, and that many central banks have not handled this very well because they haven't communicated well about the potential for losses on their QE and the actuality. Some central banks, not mentioning any names, instead of saying, well, we made a loss, they say, well, actually, to balance our books, we'll put in a fictitious asset. This is not going to boost confidence. But as most people know, there are several central banks that have been performing very well, like Chile, Israel, Czech Republic, have managed with negative equity, but they're upfront about it. They explain what's going on, and I think that's what has been missing in recent times.
Last question, because we're almost at the hour. Please.
My name is Barbara Opper. I spent a number of years at the Federal Reserve Board on the domestic financial side back when they were doing crisis prevention. And then I was at the World Bank for many years. My question is, when will you write the book about crisis prevention and crisis management and the differences between them? The years I was at the Fed, it was all crisis prevention. It was William McChesney Martin. We had Glass-Steagall, which kept the focus of banking regulation on safety and soundness. And the financial intermediaries who were not banks could fail, and that was their problem, not everybody's problem. And also, the Federal Reserve Board at the time spent a lot of time on bank merger topics because they prevented mergers so that they prevented too big to fail. These were sort of dull, not interesting topics, but they were powerfully strong, and we didn't have a banking crisis until, until we did. Thank you.
I think that, to pick up on what other people said, it's not always the central bank that has to be responsible for everything. But in the end, when the crisis breaks, the central bank is the one that has the money. Even if they didn't have the responsibility for the prevention, they're going to have the responsibility for deciding and recommending. Yeah, maybe you don't have the power to have administrative controls, but the government will want to know, should we bring in administrative controls? Should we not? The central bank needs to be ready to have an answer to questions like that, and that's why these long-term analytical projects are so important.
There are so many more questions that we would like our panelists to answer, but some answers are in the book, so read the book. Thank you very much to everybody for attending. Particular thanks to Ceyla Pazarbasioglu, Steve Cecchetti, and of course, Patrick Honohan for being our speakers today.